These are in listen-only mode.
Hello everybody, and welcome to this month's Grow Your Law Firm webinar, Cashflow Get It Right. My name's Matt Sleater, the lawyer's accountant, and again, welcome to this month's webinar. Now, I've just been watching the attendance numbers as they come up on my screen, and I'm kind of hoping that the change to daylight saving was going to be different this year. So I think we've probably had a few people that have come and gone from our southern states that have logged on a little bit early. So happens every year when we have that change to daylight saving. But nevertheless, we'll email them a copy and they can listen in their own time. So today we're going to be covering off, and as a follow-on from my webinar from last month, we're going to be covering off looking at cash flow issues in firms, and I have clients from Cairns all the way through to Melbourne, and I speak to other clients and firms across the country around these issues almost daily, and so. For any more detail on anything I cover off and run through today, and if you have this, you can refer to my book, The Revenue Revolution for Law Firms, where I cover off in quite a bit of detail the cash flow issues in firms and strategies to fix that. If you haven't got a copy yet, you can purchase one from financiallywellorganised.com. So as I said, today what we're going to be doing is we're going to be focusing on that part of your overall financially well-organised strategy that relates to your business plan. So what I see in firms is I often see a disconnect between their levels of profitability and their cash flow. And there's a number of reasons for that we'll run through. But just before we get going, what I'd like to do is just get a bit of a feel for who we've got online today. So if you could just answer quickly these questions, just so I get a little bit of an idea around who's listening in. So if you've attended a webinar before, just a couple more seconds. Great, that'll do. Thanks very much. So we've got about 57% of Grow Your Law Firm webinar repeat registrants. So look, thank you very much for your continuing support. Hopefully you keep getting some value out of these free webinars I put on each month. For those of you who are new, welcome. You can go onto my website at financiallywellorganised.com and download all of my previous webinars if you'd like to get a little bit of further info. So just for those of you who have attended one of my webinars before, I just want to know whether or not you've attended the last month's webinar. Because some of the things that we're going to be going through today are a flow on then from my previous month's webinar. What we'll do is we'll send you out a copy of this webinar recording today, but I'll also send you through a link to last month's webinar. So probably be a good idea if you just want to watch that one as well. You'll see how some of the items flow through. So only 25% of those who had attended before were available. Were here last week. Just to get a bit of a feel for where your firm's located, are you in Queensland, New South Wales, Victoria, or other? So we're almost done, and we'll get into the meat of it in a moment. So just a couple more seconds. Thank you very much. So we've got 43% of our participants in Queensland, 36% in New South Wales, and Victoria, 18%. With others at 4%. So thanks for that. And finally, are you a principal of a firm? So the what we'll be covering off today, if you're a principal of a firm, very relevant for you, but the majority of other listeners that we have in on these webinars are generally practice managers or senior solicitors. So what we're going to cover off for you today very much is relevant for everyone. So thanks very much. About about 60% of the people who are attending today are principals, and the other 40% non-principals. So look, thanks for that. So let's, without any further ado, let's get into it. Okay, so there are three reasons that I see for poor cash flow in firms. So there's a whole lot of activities in firms that drive the cash flow. But I think these are the main three items that I see in most firms. So poor cash flow can generally be as a result of either one or more of these three. The first one's poor client engagement. And I'll go through these in a little bit more detail shortly. But to summarise poor client engagement, basically good client engagement usually fixes all of your problems. So I spend a fair bit of time with firms talking about what their client engagement processes are, and if you can improve one thing in your firm, then this is the thing that will generally help to drive improved cash flow, but more importantly, improve profitability. Secondly, I see a policy around cash flow that's for the benefit of the clients, not for the benefit of the business. So firms are often concerned about their having cash-based conversations with clients. They are concerned about timing of billing clients. They are concerned about asking for money in trust. And what I see is I see firms, because they don't address these and they err on the side of caution around that fear of cash and fee-based conversations with clients, I see that their policies and processes in their businesses support what's best for the client, not what's best for the business. The thing is with cash, if you don't have any cash in your business, you can't run it, your business won't be around. So what you've got to do is you've got to put your business first in terms of the policies. And finally, the third most important reason that I come across is poor funding strategies in firms. Professional services firms, and in particular some legal firms, carry significant amounts of their revenue that hasn't yet been collected and turned into cash, either by way of unbilled work in progress or debtors, also in terms of carrying their unbilled disbursements. And these are very bankable assets. They are the future cash flows of the practice. And I'm going to show you a little bit later in the webinar where firms don't have that right funding strategy in their firms, and they rely on funding their practices out of after-tax retained earnings, that it just continuously puts high levels of cash flow pressure on the firm. So I'll touch off that. So what do you think? What do you think in your firm would be the main reasons for your cash flow pressure? So you can choose more than one of those items up there. Just take a moment to click on each of those ones there that are relevant for your firm. Because as I said, it's often more than one thing, but the overriding principle of good cash flow is to start with your client engagement. So just a couple more seconds on that poll and getting some very normal results for what I see in most legal firms. So look, thanks for that. So the number one issue in those firms listening in today is around poor client engagement. When I look at firms, I see this great opportunity for legal firms that compared to most of the other professions, the law actually requires you to legally engage with your clients around pricing and terms and scope. But a lot of firms sort of still shy away from that cost agreement conversation, and you're very lucky with your firms as firms to be required to do this, because the better engaged your clients are, the easier it is for them to understand what you're going to be doing for them, and the easier it is for them to pay you. So if there's, as I said earlier, if there's one thing that you've got to work on, it's your client engagement. Interestingly enough, there's 43% of you also included poor debtor follow-up and not enough money in trust as as the next two most critical issues that are impacting on cash flow. And these things go hand in hand. Basically, if you've got more money in trust, you don't need to be following up your clients as much because the money's already there. What I also see in firms, particularly around debtor follow-up, is that this is left to authors and principals at different times to follow up. And within your firms, the more the relationship, the key relationship holder is required to have cash conversations with clients when they haven't paid, the less likely it is to happen. So I'm going to talk a little bit later about some strategies in your firm. And then lastly, poor profitability. Poor profitability will always drive tighter cash flow. And lastly, not enough bank funding. So that's good that that's a percentage, but a low percentage. But I also think that a lot of firms misunderstand, what the options are that are available out there for funding their firms. So thanks very much for that. That's great information. So let's now move on and look at these rules. So the rules in your firm around client engagement, when it comes to cash flow, must be totally focused on reducing the period of time between the cost agreement being signed and the cash collected. So in your firm, what you'll be doing is you have all these different systems and processes to manage risk. So if you're doing a conveyance, there's a process that you've got to go through in reviewing the contract and doing your searches and making sure settlement happens. If you do estate planning, there's key things and issues that you've got to address in preparing a will or an enduring power of attorney document. If you're a family law practice, there's a process that you've got to go through to get consent orders done and to mediate a settlement and all these. There's all of these processes that are in your business, and these processes are designed to reduce your risk. So reduce risk of something being missed, reduce risk of the outcome that you expect not occurring. Your cash flow processes are also should be designed to reduce risk. So your business can't operate without cash. So whatever systems you design within your business, they've got to be designed to get your cash into your general account as fast as humanly possible. Now, one of my favourite sayings is that if you want to change your outcome, what you've got to do is look at the processes. So if you've got processes that are very wishy-washy in relation to your cash collections and your client engagement, you've got to tighten them up. So tighten up those processes so you get a predictable outcome. So that structure of your policies and processes around cash in your business really drive that cash outcome. If you're a builder, and I'm pretty sure that most people that are listening in today have had some sort of contact with a builder, be it via a client or personally building a house, doing a renovation, whatever it might be. But generally a builder will have a contract that says you need to pay us X amount of money as a deposit to start with, and this is before they do anything. And look, builders are notorious for falling over as well. So, but you've got to give them some cash beforehand before they'll even start. But then we get up to all these stages, and you've got to pay us more, or we won't proceed. What legal firms don't do is they don't take that same approach. So you've got to be taking the approach of, if we're going to do business for you, then what we've got to do is we have got to get paid at these different intervals and at this different time frame, and you need to put X dollars into trust. And if you don't, then we need to proceed, and then we won't be able to proceed. So what happens in most firms is that they design their processes around what I call the squeaky wheel syndrome. So, those clients that complain, they get the most attention. So what happens in a firm is that they then go and change their systems and processes so that it keeps those few who are complainers, at ease. Instead, what you should be doing is developing and designing your systems and processes in your firms so that you're focusing on the majority. And the vast majority of clients will just do what you say. This is your business. This is how we need to run it. This is how we're going to work with you. If you go and buy a car, you're not allowed to drive the car out of the showroom unless they've got the money, unless that check has been cleared, unless the finance has been sorted out. You don't generally go and you don't generally go and buy a new computer unless you've handed over your credit card or you've done an interest-free deal. When you walk out of that shop, they've been paid. So you've got to take that mentality with your clients. You've got to say, this is how we work. We're not a bank. You need to pay us. And what you've also got to remember is that nearly all of your expenses are payable without any credit terms being given to you. You pay your rent in advance. You get to pay your wages in arrears, but it might be 1 week or 2 weeks, maximum a month. But generally, that just gets paid constantly. You've got to pay your PAYG withholdings. You've got to pay your BASs. You've got to do all of those things. Your telephone, you might get some credit on, but it's generally not a lot. So what you've got to do is you've got to align your funding strategy and how you're going to get the cash flow in your business to that type of business that you are. And you're basically a non-credit expenditure business, so you've got to get the cash in there early. So looking at this period of time between when a cost agreement is signed and when you receive the cash, I call this the cash gap. And here's just a very simple diagram of that on your screens now. So basically the cash gap is that period of time between the cost agreements being signed and when you receive the cash. If we go back to the rules, your rules of client engagement must be designed to reduce that period of time between the cost agreement being signed and the cash collected. So let's just do a little bit of an analysis of that. So for those first 60 days, when you're doing the work, between the period of time when the cost agreement is signed and then the engagement is finished and billed, there's 60 days in between there. And in all of those 60 days, what you're doing is you're paying wages, you're paying rent, you're paying all these other expenses, you might incur some disbursements, but you've got this cash outflow happening in those 60 days. You then do a bill. And then even though your terms might say you've got to pay us in 7 days or 14 days, the clients don't pay you until 45 days. Or let's even go out a bit further. I see 60, 90, 120 days out there. So we're just going to work with 45 days here. So the period of time between the cost agreement being signed and you're receiving the cash, in this instance, is a 105-day cash gap. The key, what you've got to do is you've got to shrink that period of time down to what is the shortest period of time that's possible. And the shorter that period of time, the greater the improvement that you have in your cash flow within the firm. So at each stage along the way here, you've got to have systems and processes built in that say, this is how we engage our client. This is how we advise them about our cash terms. and how we're going to be doing business. This is when we raise a bill. This is how much money you've got to have in trust. This is when we're going to take that money out of trust. This is when we do take that money out of trust. This is how we're going to follow you up if you haven't paid us. These are our rules around continuing work. So the more structure you have in around this, and the better engaged your clients are around that, and the more aware they are, the greater the improvement you'll have in your cash flow. So key step, reduce your cash gap. So the drivers of cash flow in your business are these. So there are really two numbers. So I'm putting to the side here unbilled disbursements, because if you're carrying unbilled disbursements, and depending on the type of practice you are, usually unbilled disbursements is the easiest thing for clients to put money into trust for you, but often our fees are the last thing that we ask for them to be put into trust. So I'm not going to be looking at unbilled disbursements today and the funding of that, but I am going to be focusing on the other two key drivers of cash flow in your practice, and this is how we measure your cash flow efficiency in your firm. The first driver is around your work in progress. And basically your work in progress is your revenue that's been earned but not yet billed. Now I work with firms where they don't record all of their time. They work on fixed price or a mixture of fixed price and time billing. But at the end of the day, whether time is recorded or not, or whether you're doing fixed pricing, it's the amount of that revenue that your team members are working on day in, day out that hasn't yet been billed. That represents your work in progress, whether you can measure it or not. So every day that your people are working, you're paying them wages, you're paying rent, you've got this cash outflow that's going out of the business. And unless you bill that work in progress and collect it, you've got to be able to fund it. It keeps work in progress is probably the loosest number that I see in most legal firms, but it is the most important number in terms of managing cash flow. Secondly is your debtors, and your debtors is your revenue that you've billed but you haven't yet collected. So we all, I think, should be pretty familiar with our debtors. Now, if we're paying GST on an accruals basis, then even though we've billed our debtors and haven't been paid for them, we still got to send the money off to the ATO on our BAS. So there's extra cash flow pressure there. When you combine these two, I call it lockup. So lockup is the total of your work in progress and debtors. So if you look at it this way, it's the amount of your revenue where you've done the work, but you haven't yet turned it into cash. It hasn't hit your general account. Often it isn't even sitting in your trust account. So when you look at your revenue in your firm, you've got to remember you're paying all these expenses, but you've got all this revenue that's tied up that isn't yet collected in cash. It's either not billed or it's billed. In both instances, it's not collected. And how we measure this is via the number of days of your revenue outstanding. So I'll try not to go into too much detail on this. At the end of the day, I'm a chartered accountant, and I keep coming back to the numbers and measure the output of activities in firms via these key performance indicators, of which WIP days is one. And WIP days is basically the number of days of annual revenue not billed. So let's say, just to explain, let's say that you've got $900,000 worth of revenue, but $300,000 of revenue has not yet been billed. So you've got $300,000 worth of WIP. So if your annual revenue is $900,000, that means 1/3 of your revenue is tied up in WIP, or 121, 122 days. So it's 1/3 of a full year. 365 divided by 3. That's your WIP. So when you think about the funding of your practice, we've got all these expenses that we've got to pay out. But what we've got is this revenue that we haven't yet billed out. So that's going to put pressure on our cash flow, the higher that WIP is. Second one is our debtors days. Debtors days are the number of days of annual revenue billed but not collected. So similarly to debtors days, let's say we had $900,000 worth of revenue and we have $150,000 worth of debtors that are outstanding. So if we've got $150,000 worth of debtors, and that's basically 1/6 of our annual revenue, or 60 days. So there's 60 days of our revenue that we've gone and spent all the cash on to incur and earn that, to derive that revenue to earn it. But we haven't yet been paid for it. The combination of these two is our lockup days. So what's the total of WIP days and what's the total of debtor days that we've got sitting? So the amount of revenue that hasn't yet, the amount of our annual revenue that hasn't yet hit the bank account. So if I continued on with that example of WIP days of 120 and debtors days of 60, that gives us 180 days of our revenue of 900,000 that's locked up. That's locked up and not into cash yet. $450,000. You know, ouch! That's a lot of cash flow. That's locked up in those assets. So we're just going to go and look at some numbers now, just around WIP days and debtors days and the impact that improvement in these days can have. So remembering, if we're talking about these number of days, and if we're able to reduce the cash gap, that is our WIP days here being our first 60 days, so the period of time when we've got this revenue being worked on in here that hasn't yet been billed out, and then the period of time when our bills have been raised, being our debtors days, but they haven't yet turned into cash, the total being lockup of 105 days. If we're focusing on strategies that are going to reduce these days, it means the cash is going to land in our bank account faster. So let's look at those numbers. So for those of you who attended the webinar last month, you'll see some familiarity in these numbers based on the efficiency factor numbers that we work through. So what I've got here is just a tool that I use when I often assess firms and looking at what's possible. So if we take our actual column there, basically all we're doing is looking at the makeup of revenue. So in this particular firm, they billed out $811,000 for the year. And that was made up by having one full-time equivalent principal and 3.4 full-time equivalent fee earners. Totally, they had available hours of 7,357 hours. That's the total of those two numbers. And basically that is the hours that have been paid while people are there at work. The number of hours that were charged by the principal and the fee earners represented productivity of 73.7% and 44.6% for principals and fee earners respectively. So giving us a total of charged hours of 3,767. What that means in this particular firm, that only 51% of their available hours total was charged into WIP at an average rate of $242. Time charged into WIP, therefore, is 911, 11% written off, so a recovery rate of 89 leaves us our billing. So I'm not going to go through that in any great detail. So we went through that in my last webinar. I've got some other webinars and information there on my website if you're interested in listening to those. But it's important that what we recognise here is that if we've got this amount of revenue of 811 and we're carrying work in progress and debtors of, in this case I've said use 230 and 175,000, then what we've got is we've got a lockup of 405 and our current days are WIP 103, debtors 79, or 182 lockup days in total. So half of our revenue, 405,000 out of our 811, is locked up in cash. So these days, I see these sort of days often in firms, more than 100 days sitting in WIP. So that's over 3 months of revenue, not even billed out yet, because of poor billing policy. I see debtors days often up around that 80 days where, there's no reason with strong systems in place that those debtors days shouldn't be anywhere between 30 and 60 or 45 days or less. So what I'm going to do here is just show you the impact of improvements in these days. So we're going to talk shortly just about how to go and improve these days, but I just want to show you the physical cash impact. So if we could get our WIP days down to, let's just say, 60 days, so that all we're carrying is 2 months worth of of revenue that's unbilled. Then by doing that, you automatically get an improvement on this same revenue, that same revenue of $271,000. Our WIP will go down. If our debtors, if we could get that to 45 days, sorry, I was jumped a little bit early there in terms of my calculations. If we were able to improve our total lockup, still calculating my numbers, it was. If we could get our debtors days down to 45, so that we've reduced our total lockup from 182 down to 105, on that same amount of revenue, our lockup reduces from 405 down to 233. And what that does, it puts an extra $171,000 worth of cash into the business. Because what's happened is we've collected $171,000 of this revenue faster. So it's a critical action that you've got to focus on in your business. What have we got to do to convert our WIP into debtors faster? What have we got to do to get our debtors collected faster? If we can combine systems and processes to drive an overall improvement in reducing our lockup, then it automatically increases our cash flow. So it's a really important number that you've got to measure. What I'm going to do now is I'm just going to combine that with some strategies around what will also happen to your cash flow in your firm if you also drive growth in your revenue. So let's assume that you had the same amount of full-time equivalent fee earners. Let's say that we just maintain the principal's productivity number, but we get our fee earners up to 60%, and we can average, let's say a $260 average rate of time charged. And we could actually we implement processes to bill out everything that we're actually entering into WIP. So that what we've got is we've got an increase in our professional fees billed from $395,000 from $811 to $1,207. So looking at specific strategies in your firm to drive these key ratios up to produce more revenue. Now, if you're able to do that and maintain an improved target revenue, then you'll also add additional cash flow onto the business of $281,000. So you've got your original improvement in your lockup, and out of that extra $395,000 worth of revenue that you bill out, you also get an extra $281,000 worth of new cash into the business. Now, it doesn't equal 395 because we've still got some of that revenue tied up in our lockup of 105 days. But by having a dual strategy of focusing on just improving your existing processes and policies around driving improvements in those WIP and debtors days, but then add a layer on top of that around improving your other fundamental key performance indicators to drive improvements in your revenue, then what you're able to do is drive significant improvements in your profitability. So that's just to give you a little bit of a picture around where you make changes in those KPIs, the difference that it actually has on what ends up in cash. So I think you can see from those numbers that it's critically important in your firm to spend the time going and assessing what those actions are that you've got to be implementing. Now, this is what I think you need to do. First of all is always engage your clients around costs. The better your conversations around your costs at the front end with the client, the better your cash flow will be. do not shy away from having fee conversations with your clients. This is what the fees are going to be. If you want to be working with us, then this is what the fees are. This is how much we need you to put into trust. This is our policy. This is when we're going to bill you, and so on. So always spend time at the front end engaging with your clients around costs. And if we go back to our quick poll results there, the number one reason that you've said today for cash flow pressure in your firm is poor client engagement. 61% of you said that this is one of the main reasons, followed by not enough money in trust, poor debtor follow-up. But 61% poor client engagement. So remembering that if we said that you've got to focus on reducing the cash gap, the number one priority has got to be engage your clients better around their costs. It deals with everything. Use plain language cost agreements. So your clients rarely will read their cost agreement anyway. But you need to make sure that it's not a document that is hard for them to read. So keep it legalistic. Your law societies have got pro forma documents to use and so on. Make sure that they're plain language. Make sure they're easy to read. What I strongly suggest is that you have a plain language covering letter that goes out with your costs agreement. So even if the client doesn't read the costs agreement, at least in your plain language covering letter, it addresses the key things that you need them to know about, that they understand what the estimate of the fees are, and put it in there. You've got to remember that clients think lawyers are expensive anyway. The people who have got a bigger issue with fees generally is the lawyers themselves and their clients. So put your fees out there. Give them an estimate. Make the range as low as skinny as possible, but make sure the fee is as high as possible so that you're already managing their expectations around what they're going to pay you. Tell them when you're going to be billing them. So we're going to bill you every month at the end of every month, or we're going to bill you at this stage of work being done, or whatever the process is. But tell them when you're going to be billing them, so that when they read that letter, they can at least, they're going to expect to get bills. Tell them what your payment terms are. You need to pay in 7 days, or you need to put X amount of money in trust, or whatever it might be. And tell them about your trust account. Have a trust policy, and tell them about it. This is how we've got to work. Then what you need to do is you need to turn your billing into an administration function. So what I see in firms is I see a very poor billing process, and usually it's because billing is left up to the fee earners to bill. So you need to build structure in your firm so that billing is admin. There's still got to be activity with the fee earners around saying what's a fair fee and what isn't. But what you've got to remember is that when you're billing, you've already engaged the client around how you're going to be doing their work. You've given them an estimate. You've told them what the rates are going to be. You've told them when we're going to be billing. So surely, because you've engaged the client properly, that billing should just be a normal administration function. It shouldn't have to rely on the fee earners to go and raise the fee. Get someone else to do it. Build a process that automates that as much as you can, that ensures that it happens. The reason for this is that if we can get billing as an admin function within the firm as opposed to a fee earner function, what it does, it reduces the work in progress days. And the quicker we can reduce those work in progress days, the quicker that we can get that revenue out of WIP into debtors. The quicker it gets into debtors, the quicker it can get into cash. So you need to be focusing on activities in your firm to get billing as an admin function. Then have at least weekly trust withdrawals. Usually firms don't have a problem with withdrawing the money from trust. They often have problem getting it into trust. But if you properly engage your clients and you say, this is what must be in trust, and ask for more rather than less, most clients have the money. They come to you expecting to pay. You set your rules so that they benefit the business, not the client. Get the money up front, get it into trust. So if we're thinking about this, if we've properly engaged the client, we've got that money in trust, we get our billing cycle reduced down so that it's an administration function, and then after the period of time that's necessary to wait, we're able to draw that cash out of trust. You can see how quickly that's going to reduce your billing cycle, your cash flow cycle. And then lastly, you need to have a dedicated debtor collection person, not the author. It needs to be structured. You need to make sure that particular person firm-wide has got a process that's agreed to. That this, if it's 7 days and they haven't paid, or we haven't got the money in trust, then they get this email or they get this phone call. There doesn't need to be any requirement to go back to the author and say, oh, should we be contacting these people for their collection? Well, no, they've said do the work. These are our terms. We've engaged them around that. They can pay on time as required. So remember before I said about the squeaky wheel syndrome. So most clients will pay on time, but most systems are designed around the minority. So the majority of clients will pay on time if they're properly engaged, if you follow the processes that you say you're going to do with those clients, and then they're contacted and given that reminder. So you've got to get out of this habit in the firm of leaving collections to principals. It just doesn't work. And there shouldn't, or authors, there should be processes that allow that to happen without impediment. So just jumped ahead there a little bit. So that's really focusing on what you do around the cash gap. It's all around client engagement, building processes around getting money into trust, timing of billings, withdrawals trust and debtors collection. But you need to structure it. It needs to be focused on those 95% of clients that do the right thing, and then you need to police it. You need to say, we're going to do this. Einstein defined insanity as doing the same thing over and over again and expecting a different result. So if you want to improve your cash flow, this is what works. You need to implement. Lastly, I'm just going to touch on funding of firms. So I mentioned this a little bit earlier, but most firms are funded either via a mixture of equity and or debt. So I'm just going to give you a picture of why, if you're funding your firm purely on an equity basis, that it often produces challenges when it comes to cash flow. So if you look at the main assets in the firm, you're going to have some office equipment, usually not enough. There'll be unbilled disbursements within that firm. You'll have your work in progress, so it's all this revenue that you're working on that hasn't yet been billed, and you've got your debtors. So your debtors is what's being billed. When you look at your debtors in your work in progress, so remember we talked about the lockup, that's your uncollected revenue. And you've got this cash outlay that you're spending, which is basically your expenses on generating that revenue, wages and phone and electricity and rent and IT and all of those things. So you've got this cash that's physically being paid out, not on a credit basis, to all of your suppliers and employees whilst you're doing this work before the clients pay you. You've then got unbilled disbursements and office equipment, which is usually actual cash. So the amount of those unbilled disbursements that you pay, you pay. There's no profit element in there. The price that you pay for office equipment is the actual cash. So when you look at these assets, you've got to fund those from somewhere. And usually what they do is they get funded in a significant extent out of your after-tax profits. So let me explain that. So let's say you've got a firm that's got $2 million worth of revenue and you pay out $1.6 million worth of expenses. What that produces is a profit of $400,000. So those expenses represent 80% of your revenue. Now, if we've got lock-up of $1 million, so our debtors and work in progress were $1 million combined, what we've had to do is we've actually had to pay out 80% of that revenue as a cash outlay, because that's our expenses ratio. So physically, we've paid $800,000 of that $1 million out as an outlay. On top of that, we've also paid out unbilled disbursements of $50,000 and equipment of $100,000. So what you've done is you've gone and outlaid $950,000 of cash to fund those assets, which are worth $1 million plus the 50 plus 100, so 1.15 million. So that's a significant cash outlay that you've got to fund. You might have a bit of an overdraft, you've got all this money sitting in debtors, but basically it's come from your after-tax retained earnings. So if we look at that profit there of $400,000, and we applied, say, a 47% tax rate to it, that means that we're left with 53% after tax of that profit that can turn into cash at some point in time to fund those assets. So if that was your balance sheet and that was your cash outlay and that was your profit ratios, then that represents 4.5 years of after-tax retained profits just to fund those assets. So it's very critical in your firm to get the balance right between how much of your after-tax retained profits you're going to be leaving in the business to fund your assets and how much of it's going to be funded via debt. So usually it's a balance of both. So a critical thing that you really need to be focusing on. So guys, just to recap, the three key things that you need to be focusing on to improve your cash flow is one, client engagement. So you need to spend more time with your clients at the beginning, engaging them around your fees and how you're going to be working for them. The second thing is you need to be focusing on setting processes and policies up within your firm that are designed for the benefit of the business, not the client. If a client isn't going to pay you, you don't need the revenue. A client comes to you to buy from you, they are coming to you saying, I'm going to pay you. You buy a loaf of bread, you buy a car, you buy a house. You must pay for them before you take ownership. So this is no different with your clients. You need to get them to pay you much sooner. So what are the rules? Design them for your business, not for the client. They come to you with the view that they are going to pay you. You're a business, you're not a charity. And lastly, get your funding right. So focus on what your funding strategy needs to be in your business so that when you're funding this cash outlay, you've got some debt there that's supporting it so that you don't have to just keep leaving all of your profits within the business. The banks will lend you money to do so. So, as I said to you earlier, what I do is I spend a lot of time with firms as well as becoming their accountant. So I spend a lot of time with firms, assessing their profitability and cash flow within their firms, and then working with them on strategies to improve that. So something that I'd like to offer you all today is a free cash flow assessment for your firm. So if you'd like to take me up on that, it takes about 45 minutes. I just give you a little bit of information via a very short questionnaire, get some information basically about your revenue, WIP and debtors, and so just click on that box and let me know that it's something that you'd like to look at. So just a couple more seconds to do that. So great, thank you very much. And then just to wrap up, if you can just email me at matt@fwo.net.au, and I'll just check that off against your responses there, and we'll get that online meeting scheduled in for over the next couple of weeks. So just drop me that email to matt@fwo.net.au, And our next Grow Your Law Firm webinar, which is most likely to be the final webinar for this year, given that December is always a mad panic getting things done before everyone closes down. It's focusing on how to drive proactive revenue in your firm. So my webinar last month was focusing on improving those core numbers in your practice. How do you improve productivity, focusing on getting those ratios right between your labour costs and your revenues that you're generating. Today is about strategies for improving your cash flow. Then what we're going to do is going to bring all that together with showing you what you need to be doing within your firm to drive new revenue, both from existing clients and from new clients. And I'll give you some insights. I'll give you some insights into product marketing and sales strategies around that, so that you're also focusing on growing your revenue. So look, thank you very much for your attendance today. You'll all get emailed a link to the recording. As I said, I'll also organise for the link for the previous webinar to be emailed through as well, so that you can see the whole picture. Don't forget, take me up on my offer for a free 45-minute online assessment of your cash flow. And if there's anything that you'd like to run through with me, always just drop me an email or give me a call. My name's Matt Sleater from FWA Chartered Accountants, the Lawyers Accountants. Thanks very much.